The information provided in this podcast is for general information purposes only and should not be considered as personal advice. Always consult with a qualified professional or expert in the relevant field for personalised advice tailored to your specific situation. You have to look at different providers. Now, there are hundreds of different super funds out there, and they will all have underlyingly different insurance structures in there, and they all have different policy definitions inside there. To sort of make this even more mind-blowing, cover decreases at different rate for different people, or might remain the same, but your premiums are potentially going up. Not only there's a definition aspect of it, there's a different conditions on the policy, there's different premiums on the policy, and the cover's either going down or remaining the same. If I'm paying money to an insurer, personally, I definitely wouldn't want it to go down. Now, in some cases, it might be applicable and might be reasonable, but why would I pay someone to pay me less?
Welcome to the Wealth Guide podcast. Ryker family welcomes everybody to the next episode of what's going to be a very exciting series about finance and everything you need to know. Today, we want to talk about something quite serious though, life insurance. Is life insurance a scam? We've got a lot of clients that come in with detailed questions about this. So we want to basically shed some light for you on this topic and discuss it in some detail today. Think about your own situation. Have you ever thought about life insurance? Have you seen advertisements about it? You might have noticed it popping up on your super statements. And you've never had to use it before. It just sort of sits there and you seem to be paying for it. So a lot of our clients come in and ask us this question. Is life insurance a scam? So I'd like the advisors to just introduce themselves so that we know who we're talking to today. And I've got the wonderful Ricky sitting next to me, so we might start with you.
Hello, everyone. Ricky Rejby, Senior Advisor at Ryker Capital. Good to be here today, Jazz.
And next, Ray.
G'day, Jazz. Ray, Senior Advisor, Ryker Capital. Looking forward to unpacking a little bit about this life insurance as a scam. Quite exciting.
I can't wait either. Last but not least, in the corner.
Yeah, hello everyone. My name is Dean Dasuki, Senior Financial Planner as well at Ryker Capital.
Amazing. And I'm Jasmine Loke. I'm the General Manager at Ryker. And I'm very, very passionate about this topic because if we're going to put our hard-earned dollars towards something, we really need to be sure that it's going to be working for us. So when you think about life insurance, before we get started, I just wanted to iron out, I guess, the type of insurance we're talking about here. So I might start with you, Dean. Can you just tell us in a few words what life cover actually is and what you insure yourself against there?
Great. Well, look, it's pretty simple. Life insurance is more designed that in the event something was to actually happen to you and you were to pass away, then a lump sum is then provided to your family. And the whole purpose behind that is actually to make sure that financially speaking, that if anything was to actually happen to you, your family is not going to have that financial burden on top as well. And it could include things, and we take into consideration things like making sure debt's paid out. If you're the sole income earner, making sure that there's a lump sum there to continue to provide for the family, just to make sure that at least financially everything is well taken care of.
Perfectly explained. Thank you, Dean. There is another type of cover that's included in this. It's a very long name, total and permanent disability cover. Ray, do you want to just outline for everyone on the podcast what that is?
Certainly, Jazz. Look, total permanent disability, also known as TPD, is most of us will find that in our super statement. Now, I know some of the things that I've sort of heard from people is going, I don't think I've got any insurance in my super. And I tell them going, I think you need to have a good hard look at your super statement to see actually what this cover entails. So most of us do have that within our super fund. So I remember when I first started out with the Commonwealth Bank, I got these automatic covers sitting in there, which included, as Dean explained, life insurance, and the other one was total permanent disability. Now, what TPD or total permanent disability pays for in the event you are totally and permanently disabled. Now, what that means is loss of limbs, loss of legs, loss of eyesight. So there could be a variety of events that could leave you in that destitute situation, whether it be in a car accident or blindness or any of those events that would constitute as a TPD event is what TPD pays out for.
And you get a lump sum, don't you?
You do indeed, yes.
Yeah.
You get a lump sum payout, one-off lump sum payout.
And I've also heard of some, quite degenerative diseases that actually make you unable to sort of live your life the way that you would have before.
Yeah.
So if you can't live your day the way you used to, you can't dress yourself, you can't feed yourself, you might not be able to move around your home, that's when you get a lump sum of money to allow you to pay for the adjustments to your house or your medical bills. The third one is a little bit less well known. Ricky, do you want to just talk us through trauma or critical illness cover?
Absolutely. And you're right, Jazz. Not many people know about this trauma cover, or it's also called critical illness cover. Now, what the whole idea or whole premise behind this cover is to provide a lump sum payment to a person when they've suffered a critical illness, which could be in the form of heart attack, stroke, paralysis, burns, for example. So there's a list of conditions, a quite long list of conditions. If someone is diagnosed, cancer is another big one.
Yeah.
So if someone's diagnosed with cancer, for example, different types of cancers, they can get provided a lump sum amount of money. Now, that's designed for a person to take some time off, reassess their situation. You could just imagine if someone's been given a cancer diagnosis, they will be panicked. They would want to take some time off. They want to, reassess their situation. So that's what that cover is there for. So it provides a lump sum so the person can take time off. They can pay some of mortgage and just reevaluate how they want to move forward.
Not only that, I think provide for the medical illness itself.
100%.
Because I think there's this massive gap around what a private health fund covers and then what your trauma policy covers, right? So I think what we need to sort of clearly identify here is what is your trauma policy going to pay out? What is health insurance going to pay out? And people have this mindset or thought process going, but I've got private health insurance. So I think we just need to sort of unpack that again a little bit to sort of clearly distinguish between trauma and the private health insurance side.
No, you're right. They're very different.
Yeah, and an interesting fact as well, I remember quite a few years ago, back in 2018 or 19, they were saying the average cost for medium care of cancer was around about $150,000.
It's a whole lot more now.
So it's so expensive. And I can only imagine what the numbers and the figures look like now.
Yeah. Wouldn't surprise me if it surpassed over $300,000.
So I might just talk about salary continuance or income protection then. That's the fourth cover that we've got in that suite of life insurance products we want to find out if they are a scam. And I like to explain that with a little story. Imagine that you've just taken a year off, you've reassessed yourself, you've done some more studies, but it's time to get back to work. So you're putting yourself out there into the employment market and you're very excited because you just got a job offer. Let's call it Company A is offering you a $100,000 salary. You're super pumped about this. It's more than you used to earn before. Your studies are paying off and you're very excited. But then there's Company B that you've also applied for and they've made you a second offer and they're offering you a salary of only $97,000. But they've got this awesome benefit that they offer to all their staff that if they're sick or injured or they can't come to work for a longer period of time, something that's a bit more extensive than the sick leave, they actually offer to pay you 70% of your wage until you're better, until you can come back and do your job again.
So you're telling me, Jazz, they're going to take away $3,000 off me?
They are going to take $3,000 off you.
I'm not too sure. I'm loving the company.
Could be a scam.
No, I'm kidding.
On a serious note though, which job would you take?
100% B, because, hey, if I'm destitute in any which way, I'm getting paid till age 65. I love that proposition. So why wouldn't I take a little bit less, perhaps 1% or a bit less of my salary or 2% less of my salary and still get paid to age 65? Should something go wrong, I love that idea.
And look, that Company B would be using income protection, okay? So that's an insurance policy that essentially pays you a portion of your wage if you are unable to go to work and a doctor said you can't go to work.
Yeah.
It does sound a bit like a scam though, doesn't it? So I might just jump in here with the first proposition that we've heard probably plenty of our clients say to us, and that is insurance companies don't care about people. All they care about are profits. What are your thoughts, Ricky?
Well, that's an interesting one, Jazz. Insurance exists to provide for during an uncertain time. So that's the whole premise behind insurance, is to pay for premium in order to ensure if an uncertain event was to happen, then you are covered for. Now, insurance companies exist for profit. Look, I don't agree with that, and I've got to say I haven't been paid by an insurance company here to come here and say that, because I have seen it myself. I've helped clients making claim and which have gone through. There also have been news where insurance companies haven't paid a claim. Now that goes down to the point that when the insurance application was taken, was the client upfront and honest about their disclosures? So this is where it comes to the point where at the time of application, if a person is open and honest with their claim and they've disclosed everything that they should to the insurance company, then at the time of claim, then generally there is no issue. You could just think yourself, if you were the insurance company having to pay out $1 million worth of claim, they will do some due diligence, and that's part of normal process. So in that, they also uncover if there was anything that should have been disclosed and hasn't been disclosed. So do they only exist for profit? Yes, they are a company at the end of the day. They do need to make a profit. However, they do provide a service and they do pay out claims. And in my experience, I've seen claims have gone through and it has changed clients' life for better.
Okay. But I mean, I still think that there's a lot of people listening to this that will probably think, well, they make so much money. You know, the premiums that I pay don't seem to add up with this thought that I might never have to use the policy. So let's deep dive a little bit more. I can hear that you're saying, Ricky, that there are these things that I seem to need to do to make sure that my policy pays out. I think that might lead to some of the confusion around people not getting paid. Do you want to deep dive a little bit more into that, guys?
I think let's take a step back, right? So again, I'll come back to the similar sort of example of what I had inside my super when I first started working. I think this is where people sort of might think the scam bit comes out. I had this policy inside my super fund where there is a lot of restrictions and exclusions around what he would pay me, what he wouldn't pay me for. So I think first step is to sort of identify, let's see what I've got. What am I paying for? So having a look at super fund and go, I'm paying for this life policy, I'm paying for the disability, I'm paying for this income protection. What is the construct of this policy? How did it come about? What are some of the terms and conditions? And this is, I think, what pays you to sort of sometimes speak to an advisor to go, hey, can you explain what is the difference between this policy and another policy that I might look to entertain? So this is what you call a non-underwritten policy, which is an automatic policy that you might get from your super fund. Now, the flip side of that is where you get a retail policy where you have been gone through a process of an underwriting, you've gone through an upfront process of doing the blood tests and medical tests. So what the retail insurance company is asking you to do is going, hey, before we take any money off you, what we want to do is put you through a bit of an underwriting process. What does that entail? We're going to ask you some medical questions. We're going to ask you some lifestyle questions. We're going to ask you about your health, and you put you through a bit of a blood test and a doctor's report. Now, based on those doctor's medical and financial reports, we might then determine whether to give you cover or not. So what insurance company is trying to say over there is going, before we take any money off you, we want to do all these checks and balances first, and then come around claim time, it will make a lot easier for us to pay out. Now, in the past, people haven't been paid out on those policies in super because they might have stuck, what I've heard is that people have been stuck within these policy definitions and structures where they've gone, I didn't get a payout. Now, this is where people might think that they've been scammed. They've been paying for this policy all these years and they haven't been paid out. With any part of the retail policy where you've gone through an underwriting up front, usually in some of the most of the cases that I've dealt with, the clients have been paid.
So there's been several times when I've had meetings with clients where one of the objections that I got was the sentence, look, Jasmine, I know exactly what's going to happen here. This is all a scam. I'm going to be paying for my premiums, and when it comes time for me to claim, the insurance company won't pay up. Have you heard anything like that from your clients, guys?
Well, funny enough, I actually had a client that actually took a policy with an over-the-phone insurance company, and he was a labourer, and he broke his leg. And he went to make an income protection claim, and the insurer turned around and said to him, look, we're not going to pay you. And then after that, they ended up only paying him for a month because the lady who was talking to over the phone made the mistake saying, okay, well, look, we'll process your claim and we'll pay you. But then he was out of pocket. Like, he paid all these premiums and he just never was able to make a successful claim. And he broke his leg. Like, he can't work when you break your leg, given the occupation that he does.
Absolutely. I can think of a couple of situations where I've just recently met a client and they've been paying funeral cover. It only covers them for $15,000. they pay nearly $3,500, nearly $4,000 in premium, and they've been paying for us over 10, 15 years.
Wow.
And I said to the client, that's nearly 40 grand you paid out in premium to get $15,000 worth of cover. So, yeah, and I just had another tradie come to my house fixing a couple of things. We were just talking because he asked me what I did, and I told him about insurances and financial planning. And he told me his story that he had a income protection cover again with over the phone insurance company, and he tried to make a claim because he did his back. And they declined him, and they said, instead of paying claim, they just said, oh, here, have your premiums back. So he had disclosed everything to them, but instead of that, they just paid him his premium back just to go, okay, that's it, we're done here. So
like they voided the contract.
Exactly.
Disappointing.
Wow. See, it's a lot of things there that can make clients think insurance is a scam. Ray, have you got any client stories you can share?
I do have a particular case in mind. Look, obviously, with one of my clients, when they had an income protection policy, and again, they had this policy inside super fund, which again wasn't per se specific to me, but this was while I was working in the bank. I knew one of the advisors that was sort of helping a client through that process. He had a client who's was going through a cancer event, and during that event, when they applied for this claim, they simply denied the claim, or firstly, it took almost around 6 to 7 months just to get through the application process, go through. But even after going through all of that, now the claim was declined at the end. Now imagine having the financial pressure, and then you got this medical pressure being diagnosed with cancer. It was just heartbreaking to see that the client's going through such a financial stress and a medical stress at the same time. Unbelievable.
No, look, and this is the heartbreaking part, and I think that's why we're going to get a lot of people clicking on this podcast and listening to you talk, because it's really difficult to understand. It's a completely different world. It's like if I go and build a house, I have no idea what to do. I'm completely reliant on those tradies and the builder or the building companies that I deal with to really look after me. I think this also came out really strongly, the sort of consumer sentiment and the government's sentiment, the regulator sentiment around insurance during the Royal Commission. So one particular part that I can recall there was new anti-hawking provisions. So a lot of the banks, what they used to do is they used to sort of say to customers, at the end of a transaction or when they were calling them over the phone, oh, we've also got this insurance. You can buy this insurance and, some of them, for instance, pay off your credit card if you can't. You should just pay for that. It's a couple of dollars a month and, never mind. It's not a big deal. Why don't you just say yes to that and sign up for that? And there was some people that actually were vulnerable people that shouldn't have been able to agree to make such a contract. So there might have been elderly people, there might have been people with a disability. But because these things were often done over the phone or via opt-ins with emails, the government's actually restricted now that sort of on-selling of insurance products without someone being behind that phone call that can really explain to the person what the cover is. So you now have to have cooling off periods, and there has to be time in between someone taking out, say, a credit card and being offered insurance to protect you against if you can't pay off that credit card. So Royal Commission even talked about this. So this is a real thing that is happening in our community. Dean, if you sort of had to guess, why do you think clients feel often that an insurance company just won't pay out? Do you think it's actually about getting the payout, or do you think it's maybe the process leading to the payout?
I think it's a bit of both, to be honest. I think to get a claim and go through the whole claim process on its own can be a bit time consuming. Takes a little bit of time, and then I think a lot of the time as well. And I don't know, the guys might be able to relate as well, but we always hear stories, and clients always hear the bad stories. The XY had someone went to go make a claim, nothing was paid out, and then I think it just disheartens a lot of people, and which I wouldn't blame them as well. Like, you sit down, we work very hard for our money, for them to us to then pay it to an insurer that's not going to pay out to us, which just doesn't make sense. And it goes back perfectly to Ricky's example where he had that client paying $3,500 a year for a $15,000 policy.
Look, another thing that I often hear is, when clients come through our doors, they might have already tried to get insurance before. And another comment that I get a lot is, don't even worry about applying for insurance for me, Jasmine, because I'm just going to be declined. I've tried this before and I didn't get any cover. So have you got any stories about that? Any experiences where clients might have been declined?
Multiple at my end, Jazz. Well, we've had cases some of my customer cases where they've sort of gone and applied for a policy, and when they've sort of gone through a process of applying, whether it be using the blood test or by the application method, they might have disclosed some of the scenarios where that wasn't explained adequately. And if it wasn't explained adequately and taken that at a very surface level, the insurance companies have gone, right, not going to cover you.
Have you got any clients that you recall where you've got a bit of a story you can share of their circumstances?
Specifically, it was more around the medical side. Mm-hmm. So if I'm talking about this specific individual, she went out to disclose to an insurance company that she had breast cancer, or no, not she had breast cancer. Her sister had breast cancer. Now, breast cancers, there's a specific genes, which are the BRCA genes, that will sort of, the insurance company needs to know that if you've got the similar sort of genetics. And if you do, then yes, they have got the right to decline. But whereas if you've done a genetic test yourself and if you don't, usually most insurance companies will be open to accept you. Now, because they didn't further delve into her medical situation or her medical condition with the breast cancer genetics, at a surface level, insurance company's gone, right, we're going to decline you. We're not going to cover you. Now, she carries that decline on her name, which means that if she was to ever apply for a further insurance anywhere else, she's thinking going, I've been declined. There's no point.
Ricky, how does it make a client feel when they hear things like this? Do you think that it's that moment again where you go, this is just all a scam? You know, I'm great. I'm working. I've got my kids. I'm running around. You know, I'm a functioning member of society. Why should you decline me to get insurance cover?
Well, there's different situations where cover would be declined, but for a client when sometimes we have to give them that news that their insurance company is not accepting cover, or I've had a situation I could think in my mind. I had a scientist that I was insuring, and the insurance company would not accept that they are scientists. So it was just we provided everything, but they would refuse to accept it. But I do have to commend my client, and she did not take that. She said to me that they will have to accept that, and we had to provide, apparently to be a scientist, you need a certificate, which wasn't provided initially. I can't remember now, I can't recall the name of that certificate, but once she had to go back to a uni where she did her PhD and everything, she had to go back. So it took us like 3-4 months to get the cover. But she did provide that, and when we provided that to the insurance company, they accepted it.
That is hilarious.
I love that.
That is hilarious. So insurance company just literally gone, you're not a scientist.
You're not a scientist. Yeah. You're just an admin person.
Never mind your PhD.
All that in vain.
But Dean, I mean, I get it. I can see how clients might think this is all a scam, you know, especially when you're getting news that you really didn't want to hear. What do you think is sort of the emotional roller coaster for a client when they hear things like this?
Once again, like for an insurer to say that you're not a scientist, right? It discredits you and it discounts everything that you've done over the past couple of years or your whole working profession. Just for an insurer to say it doesn't matter, it can be quite disheartening.
Rejection is the first thing that comes to my mind. Is I've been left out and been rejected. Why have I been rejected? Without a proper explanation, without giving me the courtesy or letting me know why you've done a certain thing.
But as well, clients take it personal. Like I've had situations where a client has had an exclusion. So they weren't even declined, they just had an exclusion and the client took it personal.
Absolutely. I absolutely would take that personally.
I totally get that. Look, I think another one that I get a lot when I speak with people is, I will get this insurance and okay, you know, we'll work out a price, but I know how this is going to work. It's just going to keep getting more and more expensive. The whole thing is a scam. Does that actually happen, guys? Do you see that the cover gets more and more expensive over time?
It does, Jazz. It actually is with anything else in line with CPI and the inflation, the cost of living. Everything does go up in line with inflation. However, what you don't want is your cover going down with it. So you don't want to be paying more and your cover's decreasing with age.
That definitely sounds like a scam. Tell me how that scam works right now.
So I would encourage everyone to look at their super statements and compare it to maybe a statement from 2-3 years back and look at the level of cover they had at the time and the premium they were paying, and look at it again now with the level of cover they have now and the premium they're paying again.
Are you telling me that my cover is going to be less, but I'm going to be paying more for it?
Yeah, absolutely. That's how generally the cover inside super works.
That is definitely a scam.
And to Ricky's point there, Jazz, you have to look at different providers. Now, there are hundreds of different super funds out there, and they will all have underlyingly different insurance structures in there, and they all have different policy definitions inside there. So to sort of make this even more mind-blowing, cover decreases at different rate for different people, or might remain the same, but your premiums are potentially going up. So not only there's a definition aspect of it, there's a different conditions on the policy, there's different premiums on the policy, and the cover's either going down or remaining the same. If I'm paying money to an insurer, me personally, I definitely wouldn't want it to go down. Now, in some cases, it might be applicable and might be reasonable, but why would I pay someone to pay me less?
Well, I've also heard of people saying things to me about not being able to actually get the amount of cover that was paid out. So let's say they were lucky enough that the insurance company paid the claim, but then it was trapped inside their super. I can see another scam here. Guys, how can that happen? Have you ever seen something like that before?
It does happen, Jazz. Depends on who is the owner of the cover. That's where it comes down to. So if you have cover inside your superannuation, the trustees of the superannuation are the owners of the cover. Even though super is in your name, in the statement you have your name, but the trustees of the super own that cover. So your superannuation, being a separate entity, owns that cover. So hence you might have a situation where a payment has been made. Generally, you'll see that for income protection because life and TPD generally they are proven, and they are also a condition of relief for super, so they do get paid out. But some instances we have seen where the insurance company has paid, but because the client hasn't met the superannuation condition of release, the money gets trapped inside super.
That's right, because you can only take your super out if you are retired.
Correct.
Or once you pass away.
Now, it could be X, Y, and Z super. To put as an example for what Ricky's saying, let's just say your super fund's name, X, Y, and Z super. Now, they're all called the trustees. They own the policy there for you on your behalf. And when you make a claim, that's where the impact will occur, whereby X, Y, and Z super will decide going, Jasmine, do you meet this condition of release or condition of payout? Should we pay you this cover?
Now, look, I can see how people could get caught up with issues there if they don't have the right fund and the right cover. Another thing that I would like to touch on in this same context around insurances and super, you mentioned earlier that one of your clients has a policy that won't ever pay out as much as they've paid into it. I've also, in that same breath, thought about a client that I had that had insurances in their super fund. And they were putting in a good amount of money every year. I think it was around $1,000 a month. So they were really adding quite a good amount of super. But they never saw their super balance grow. Now, we did some investigating into that one, didn't we, Dean? And we actually connected that back to their insurance premiums. Do you want to talk about that case?
What actually had happened was a client had some super and some insurances structured within inside their super. And as Ray was pointing previously, what tends to happen is your level of your premium will slightly increase every year. Now, because your premium is increasing every year, here you are putting $1,000 a month into super, but potentially your insurance premiums are that large that it's probably consuming a lot of that $1,000. In this case for the client was paying roughly around about $700 a month in cover. So they were only getting $300 going in. So when you come and look at the end of the year, you may have put in $12,000, but if a majority of that has gone to funding premiums, then your super is not going to grow. And I've personally seen it as well, not just with this client, but with many clients. And the scary part is that as you're approaching to that retirement stage, it's just going to slowly dwindle away your retirement savings. And the concern with that as well is if you're 60, well, you're supposed to retire within the next 7 years.
No, this was a heartbreaking story. I'm glad we were able to help that client. We'll go into some of the things we can do to support you in a minute. But I do want to address a couple more elephants in the room. And probably the biggest thing that all of our listeners and viewers are thinking about right now is we can talk about all of these things, but there will be one thing that will remain. And that is that super, insurance, all of these things, they're not just complicated. It's also really expensive. I mean, we've got car insurance, we've got home insurance. Now we're supposed to have all this life, income protection, TPD cover, critical illness. Isn't it just all really expensive? And then looping back to the beginning, insurance companies are just here to make money. So why should I pay my hard-earned money out for these really, really expensive policies? What are your thoughts on that, guys? Do you see clients with that objection and that concern?
I see them all the time, Jazz, but I think it comes to as a matter of your priorities in your life. So it all boils down to your primary goals and objectives as to what you want to do in your life. Now, for me, if I look at myself, for me, in the priority order is my income protection. Now, why that's the case is if I don't have income, I can't pay for my car insurance. I can't pay for my home insurance. I can't pay for my content insurance. I can't provide food for my kids on the table, and I can't pay that mortgage. So for me, the primary objective has always been, above and all, I want to cover the biggest asset that I've got, which is my income. Because if I don't have my income, I certainly can't pay for anything else. So for me, the priority became income. Now, I'm not saying to people here to go cancel your car insurance and go cancel your home and contents. Please don't. I'm putting things in perspective to go, what should be in the order as far as individuals' primary goals and objectives should be. So for me, that's income protection, followed by life, TPD, and trauma cover, and they've got the other covers there. Now, it is important for people to understand and review those covers and policies that sits either within the super fund or externally, and have that review on a regular basis, and always talk to your advisor. Speak to your advisor every 2 to 3 years or every year on how that policy is tracking for you.
So what you're saying to me, Ray, is yes, insurance has a cost.
It does.
And it's definitely something we acknowledge. But the other side of that coin is the opportunity cost.
Correct.
Of not having that cover.
Correct.
And what your family situation would look like if you didn't have it.
Exactly.
So I guess from me to you, it's very important for you to think about, it might cost me X $100 to have the insurance, but what would be the other side? If I didn't have that insurance, what would it cost me and my family if I'm in a desperate position?
What is the cost of not having it?
It's the cost of not having it.
Just to add to that as well, something that I find very ironic is that a lot of the time people are happy to protect and secure their cars. They're happy to protect and insure their home, but their most important and most vital asset is their income and their ability to continue to work and provide that income. Yet a lot of the time people are not really too fond about it. They're not really too concerned, which I just find ironic.
Well, it's a similar to example. I just remembered thinking about this conversation. I just remembered our flight to Brisbane, where when we have started flying again, which is good.
Yes.
Well, I remember the announcement on the flight when they say, in case of emergency, put your mask first, then help others and your family. So it goes back to the same point of insurance. If you haven't covered your own self, income being the main one, your life cover, because you are providing for your family. So if you're not covering your own self, how are you going to look after the family? So it is an important factor.
Yeah, look, I do think it's money well spent if you can have that kind of peace of mind. So let's put that into perspective. Ricky, you and I looked after a couple once, and in good news, they were actually able to make a claim that was paid out. So even though it was sad that we had to help them through the process of making a claim, we did end up getting the claim paid out. It was a total permanent disability claim. And because the cover was held in super, even though there was, they were fully excited about getting the claim paid out, they still came into our office and said, insurance is a scam. And the reason they said that was because of tax. Do you want to just talk to us a little bit about that couple and the wake-up call that they got when it came to the payout, and it was just a little bit smaller in their bank account than when it was first paid out?
Absolutely, yeah. So in our situation, the husband had an injury at work and was, had gone through the whole process, having injured his back. He wasn't able to work again. So he was able to satisfy both by the insurance company and the superannuation fund, the trustees of super fund, that the client is unlikely to work again, being total permanent disabled. However, as the claim gets paid, because like we said before, if the owner is superannuation fund, so the claim got paid into super. Now what happens is when the claim gets paid out, that's when there could be some tax issues applicable when the funds are being taken out. That depends on multitude of different things, being client's age, is it taken as lump sum or is it taken as an income stream, and a variety of different things, so which is where, the client did say it was a scam.
You came into the office and said, this is a scam. The tax man is everywhere.
So they were happy they got paid and was released. However, there was some tax issues that we had to work through.
Yes. And look, I think this is probably a really good point for us to change the conversation a little bit, because we have very open and honestly spoken about some of the things that are challenging for our clients. This is not their main job. They don't think about insurance and paperwork and policy documents and super for a living. The good news is we do. So we actually know that insurance companies are there to protect and help people in the community. Yes, they are for-profit businesses, but that's actually really important because insurance companies are a crucial part of our social system. So they take a lot of the burden off governments and individuals. For a small contribution towards a policy, they will actually pay you out at a time that you need it most. I think the key critical theme that I've been hearing throughout our discussions today is that it becomes very complex. It becomes very time-consuming. If you're making a claim, emotionally, you are not in a great place. You are at that point in time in a situation where you are desperate, you're scared, you might be ill, you might have a lot less time. So I think what it comes down to for us as financial advisors is helping you understand that insurance is not a scam, but it can definitely have a lot of traps. So I want to spend a couple of minutes just talking about some concepts where you really do need to watch out so that you don't get caught up by insurance being a scam in the sense. So why don't we start off with this whole concept of cover? So we've dropped a couple of names before. There's cover you can get on the television. There's cover you can get over the phone. There's this other cover that you can get through your supers. But then there is also a cover that you can get that you have to go through a lengthy process for, and you get personally underwritten. So I might just get started with you, Ray.
Certainly.
Talk us through the differences in those covers and tell us how we as consumers can make sure we don't get caught out.
Certainly, Jazz. So I think the key thing to remember here is firstly starting with the point of view, what do I have existingly? I think it's a self-reflection process of going, let's have a look at my super statement. Let's look at what covers that I currently hold within those structures that I've currently got. If I've obtained insurance over the phone, what does that entail? What does the PDS entail? What are some of the events that I can get caught out on? So I think it's important to understand those factors. Now, if we don't have the ability, I think it's a good starting point to speak to an advisor and ask them going, hey, can you point out some of the differences and help me work out where are some of my moments that I can get caught out on and not be paid? So it's important on the first side to understand what I've currently got. And then once you sort of work that out, then you start to unpack a little bit more around what should I have? Should I have the appropriate amount of life, disability, trauma, income based on my personal situation? Now, these will differ from person to person. So what I need and what you might need, Jazz, would be completely two different covers altogether. And then it would sort of depend on who's the primary income earner in the household and who does what and what kind of support roles they do in the household. So those are some of the starting points that people should start out with, firstly, to understand what kind of cover they should work with.
And I think there's a pretty telling difference between, say, a policy you get on TV and a policy you get underwritten, and that's usually the price. Now, there is a very well-known saying, you get what you pay for. So, Ricky, do you want to just talk us through what's the application process of, that sort of quick flick cover you can just get, and then the cover that is more expensive, but yet tell us the benefit of that.
It all comes down to the policy definition that we've already spoken about. It's about when they advertise cover for a price of coffee a day. It just depends on if they don't know anything about you up front, then they will what we call a process of underwriting, where in other words it's just getting to know you, getting to know the client. So it depends on what cover you take. You can either go with a cover where they don't want to know you up front, but they'll ask you to pay a premium up front. So then the insurance company has very little information about you, your health, what you do, as opposed to an underwritten cover where they take time to get to know you. They take time to know what you do, not just admin manager. They get to know what does your role involve. They get to know your health, what other health conditions you are going through. And then that cover is personalised and tailored to that client to ensure that the premium reflects what their situation is. So for a person with a office working job with less or no medical issue, their premiums would reflect that. And that gives client a peace of mind is, unfortunately, at a time of claim where they're already going through a stressful time, they don't have to go through an underwriting process at the time of claim, which would mean that they have to explain everything to the insurance company. They're already going through a hard time. Imagine having to go through more paperwork. So that's the last thing anyone wants. So an underwritten cover, I'm not saying you don't have to do paper, you will still have to. However, it'd be a lot less, the claim process will be a lot smoother.
Not to mention your advisor will help you at that point in time. And it's a key thing, have a good advisor next to you who will help you along that journey.
And I think for me as well, just to give people a little bit of peace of mind, that cover that you get really quickly and that's not as expensive, it is possible that you potentially may have a negative claim experience. And a lot of the time when clients come to us, they might have been through something like that. They might have had family members that have been through something like that. But we are blessed to be able to then show them this other type of cover where you actually make a very well-structured, well-prepared, well-thought-out deal with the insurance company, a proper contract where they say, okay, we'll get to know you, we'll agree on a price, and then we'll cover you. And because you've done all the work, when it comes to claim time, it's a very different conversation. I've often found this as well, and this is why I'm so pleased that there's people listening or watching this podcast, because you're educating yourselves, guys. You're thinking about, all right, I need a plan B. I can't be without some insurance, something that backs me up. I don't want to pay money into a scam. So let's find out more about what can I do to really protect myself. So we've talked a lot about this cover where you're having issues at claim time. There's something you can do about that. Just negotiate properly with the help of an advisor, with an insurance companies in the first place, and you're very unlikely to have a negative claim experience. I think the other thing I do also want to touch on again is just around all these myths about insurance and superannuation, and also about all of these issues that have occurred, especially in the sort of 2010 decade, around people getting their insurance out of super funds, because there's been a lot of change there, and legislation used to still be new. It's now not new anymore. So advisors and insurance companies are well versed in making sure that the cover they provide you can suit your needs. But doesn't it come down again to that difference between group cover and then the proper cover, Dean?
Yeah, it does make a very significant difference between group cover and underwritten cover. Once again, the group cover is more designed, and we did touch upon this on one of our previous episodes, but group cover, you're going into a pool of people. You're being insured part of a pool, whereas when you're underwritten, you're actually underwritten and the cover is written specifically to yourself. And just exactly like what Ricky was saying earlier, at the time of the claim, because they've personally assessed you, then at time of the claim, a lot of the time the insurer won't have anything to go off the back of because you've already disclosed all the information to them.
And you can have that sort of underwritten cover in your super fund as well, can't you?
Correct. You definitely can.
How do you get that?
Same, you go through the application process as normal, and then when the insurances are actually structured, they then get placed within the super fund. And one of the benefits, which I don't think much people know about, but having those policies actually structured within super, you get a 15% rebate on the premiums. And then also as well, your advisor might be able to help you to structure it in a way that you can claim some tax deductions on those premiums as well. So not only are you actually getting the benefit of having those policies and that cover set up in place, but also you get a little bit of money from good old Anthony Albanese at the end of the year. So,
well, I think that's definitely worth finding out how you can get part of that. Look, I wanted to also address one of the other things that can look like a scam to someone that has not thought about it more deeply. And that's around the insurance companies increasing the prices as you do age. So can you guys just give us a little bit of some factual background around why that happens, guys?
Primarily it happens because of the mortality rate. And what I mean by mortality is as we get closer to that to the end of the life, we're all going to sort of get through that part, premium basically goes up with age. So there's multiple factors that will sort of play into that consideration. So you've got the CPI indexation that will increase the premium, which means that not only your covers increasing in value with CPI indexation, but so are your premiums. But based upon that is also there's a layer of mortality rate on there, which then allows for the premiums to go up considerably with age. There are multiple things you can do about it. So there are a variety of structures that insurance companies do provide. Now, mind you, so these are primarily your big, large corporate insurance companies will go. You either have the option to go, I want to fix my premium for a certain period of time, or I'm happy to have that my premium go up with age. Now, people will decide different premium structures depending on their needs. Some people would like to make sure that their premiums remain the same, which is what I've done. So my premium remains the same, but my cover value goes up. So that has been the structure that's sort of been fruitful to me. But again, it's a conversation with you and your advisor and sort of working the chart and the calculations out to see what the numbers look like.
It's kind of like fixing your home loan.
Absolutely.
Or leaving it variable.
Like a fixed rate and a variable rate, if you like. Yeah, absolutely, Jazz.
But that seems to me then, Ray, like the stuff we talked about earlier, where the insurance premium in my super are going up, but the cover is going down. That seems like a fix for that. So you can do something about that.
You can, absolutely.
If you sit with someone that can help you structure your policy to suit your needs,
yep,
you can make an informed decision. Well, maybe you don't mind your cover going down if you're doing a great job paying your home loan and you don't want your super savings to be eaten up too much.
Yep.
That might suit you and it might be totally fine. Or if you're someone like me, German background, any safety net I can get, I'll take it. I do love to have that security of I've got exactly this amount of cover that I want and I've got that allocated to paying off my debt, paying for my kids' education. I don't want one of those funeral covers. I want to have some money set aside for if I'm not here anymore, what are my final expenses? So you can solve for that as well. So can we do something about eroding super savings with insurance premiums then, Ricky?
Absolutely, Jazz. Just going back to the previous point too, it's just in line with the insurance premium, we've also had restructure the policies in a way where as the client situation changes, that's why reviewing the policy is very important because there's been a lot of changes in the industry, new products come out all the time, companies are merging. So it's really important that the clients do review their policies every couple of years. Just to ensure that they are on the right track. And we've also had situation where as clients are getting older, and this is going back to eroding super balance, as the clients are getting older, they've paid down their mortgage, and we can also look at reducing the level of cover, which also reduces premium at the same time. So it's having that fine balance. Now, for a young person or a person who's got a mortgage and they're paying premium through their super, yes, it will erode your balance because it's like what's coming in and what's going out. So what coming in to our super generally is employer contribution. And if you're self-employed, there might not be any contribution coming in. So you might not be making a contribution. And if you're paying premiums through your super, it all comes down to the performance of the super fund. And if it's been a bad year, not only the balance gone down, and you've also paid out the premium. So in order to stop that, there is a way where people can contribute money into super. And if you've got premiums coming out of it, another way of looking at it is having to support your super. So people can contribute up to the amount of premium, less, more, depending on their cash flow situation at the time, and they can put that money into premium, into super, and erode that, so stop that from eroding the super balance. And the good thing is, they might be able to claim that on the tax, on their personal income tax. Again, that depends on their personal situation, the time, how much other deduction they've got, how much they've already put in. It's a variety of different things.
Not to mention the cap. So
Absolutely.
there is superannuation caps in there that you've got to be mindful of. So whenever you're looking at those structures of creating a tax efficiency for your insurance policy, guys, you've got to keep the caps or the concessional caps in mind all the time.
Fantastic. Look, I think we've debunked a lot of the concerns that people might have had. For me, in conclusion, the most important thing is insurance companies at the end of the day are very large and very big organizations. Having the support of an advisor, someone that can sit with you and explain the ins and outs of applying for a policy, even selecting the policy in the first place, how much you need, and then maybe being there with you if the unfortunate circumstance occurs that you do have to make a claim, reading policy documents with you, informing you of what you can and can't claim for. That seems to be a key thing. But I think that overall, it's about really being clever and smart. So not having insurance is not an option. You've got to protect yourself. You've got to have a plan B. But don't just buy something off the shelf either. Be clever and smart. Make sure you dig deep into what you want and make sure that it's going to be the right cover for you and you've got that confidence that it will pay you out when you need it. Thank you so much for listening. We're super excited to keep you updated with upcoming episodes. So don't forget to like and subscribe on YouTube and follow us on all the other platforms.